So now let's talk about Facebook. Facebook, I'm not going to talk about leases because, as I said, starting in 2019, it's been capitalized. And second, Facebook even before that was not a big lessor. It's not a company with big lease commitments. It's not a big issue. But R&D is. This graph, I show you Facebook's R&D expenses from 2011 through the last 12 months ending September 2022. If you look at the red column, which is the R&D expense, you can see that in the last 12 months, Facebook spent almost $32.6 billion on R&D, making it one of the largest spenders in R&D on the face of the earth. In fact, of the top 10 companies spending on R&D, 7 are technology companies, 2 are pharmaceutical companies, and only 1 is a manufacturing company, Volkswagen. Facebook spends immense amounts on R&D. But there's an added interesting component to this graph. One is if you look at what's happened to that R&D spending over the last 4 or 5 years, usually R&D spending tends to decrease as companies scale up. In the case of Facebook, it's actually accelerated in the last 5 years. So not only is Facebook spending a lot on R&D, the amount it's spending is accelerating. And remember, this R&D actually includes very little of what they're investing in the metaverse. We're going to come back and talk about the metaverse. So this is actually R&D kind of going into the business. Now, what I've done also in this graph is I've capitalized R&D. Remember, I said to capitalize R&D, you need a life. I used a 3-year life for R&D, and going back in time, using that 3-year life, I've created an R&D asset. This is the asset that's going to show up on your balance sheet. And in September of 22, that R&D capital invested was $53.1 billion. Remember, this now gets added to book equity as well. And finally, the blue column tells you how much of the R&D from previous years I'm amortizing in this year. And again, focusing in the last 12 months ending through September 2022, Facebook wrote off about, or should be writing off about $18.9 billion of past R&D invested. So let's step back. Facebook spent $32.6 billion in R&D in the last 12 months. It is writing off $18.9 billion. Remember, that difference of about $13 to $14 billion is now the adjustment you're going to make to your earnings. And that is exactly what I've done in this graph, is adjusted earnings for that difference between the current R&D expense, which I add back, and the amortization, which I subtract out. And I've corrected the operating income for Facebook going back to 2011 for R&D. Does it make a difference? Yes, absolutely. In the last 12 months, Facebook reported operating income of $35.5 billion, according to the accountants. After I've corrected for R&D, that looks like it should be really $49.3 billion. That's a pretty big difference. The operating margin for Facebook the last 12 months was a bit of a disappointment, down to 30% from what it was previously, about 40%. If you correct for R&D, that number jumps to 42%. It's still down about 6 or 7% from last year. But that's a pretty impressive operating margin in a bad year. This is a company that has been immensely profitable through its life. It's had a little bit of a downturn in 2022. We'll talk about why. But R&D, correcting for R&D makes a big difference to what you see as margins. Now, the other number that I want to clean up for is what kind of accounting returns. Because remember, the return on capital that a company makes measures the quality of its investments if it's measured right. I've computed the pre-tax return on capital. In fact, I should have mentioned the margins I corrected for in the previous page were pre-tax margins. I've corrected for pre-tax return on capital here. And here again, you can see correcting for R&D pushes up the return on capital from an impressive number to an even more. It pushes down the return on capital from an impressive number to a still impressive number, but a lower number. Why is it pushing it down? Because while the operating income is increasing, as you saw on the previous page, your invested capital is also going up. You have a bigger base. And this is the effect I talked about. In most years, you can see the return on capital with R&D treated as a capital expense is lower. For Facebook, it's not catastrophic. The return on capital, even with the R&D adjustment, pre-tax is 34%. Companies would kill for that return on capital. They'd gladly, most companies would switch their return on capital for that one. But there are technology companies where once you make the correction, you discover very quickly that the return on capital is now single digits. It's actually close to or even below the cost of capital. And those are the companies you want to be careful about when they map out plans for growth. Now let's talk about the metaverse. It's the talk of the moment. And I'll be quite honest, I'm a little hazy about what the metaverse is. I see a virtual world where people enter with, Facebook actually bought Oculus 2014 as a precursor to entering this world. And they spend a lot of time in that virtual world. The reason I'm hazy is that's fine, but to make money in this, you got to figure out a business model. Now, for better or worse, Facebook has made a big jump into the metaverse. In fact, they've renamed themselves based on that entry. And if you look at their last 12-month data, they basically, in the footnotes, break out their investment in the metaverse and what they're generating as revenues right now. It's broken out as Reality Labs. It might not be comprehensive. There might be investments in the R&D that are for the metaverse. It's tough to tell, but let's focus on what Reality Labs, which houses their virtual reality glasses and their entree into the metaverse, did to earnings in the last 12 months. So this is right out of the financial statement. It tells you what in the last quarter, Reality Labs had revenues of $285 million and expenses of $3.7 billion. Over the 9 months in 2022, expense of $1.4 billion and revenues of $1.4 billion. There is no way that these expenses are operating expenses. In other words, you can't tell me that to generate $285 million in revenues, you spend $3.7 billion. You're saying, what's the money then for? My guess is most of this is a capital expense and accountants are categorizing it as an operating expense. In fact, what I did was I actually took the operating income that I got before and after the R&D correction and asked the question, what would these numbers have looked like if Reality Labs did not exist? So you take out the effect of Reality Labs, your revenues are lower by about $2.3 billion. I'm talking with the R&D correction, with the R&D correction. So I'm sorry, that should be with the R&D correction, not without. So cross out the out. But take a look at what would have happened to my operating income. My operating income, which was $49.3 billion, already increased by how I treated, by the capitalization of R&D jumps to almost $62 billion. You thought the operating margin of 41.7% was impressive? Take a look at what it would have been without the metaverse investment, $53.5 billion. And again, I'm not trying to talk you into buying Facebook or out of it. But here's why I think it matters. If you treat metaverse the way it should be treated, that drop in operating and net margins that you saw in the last 12 months should not be read to mean that the operating business, the online advertising business, is somehow melting down. It's not. It's still a cash cow, a tremendous money machine. It just reflects the fact that Facebook is making big bets on R&D and on the Reality Labs. Second, if you're doing pricing, let's take price earnings ratios. At the time that I'm doing this session, Facebook's market cap is about $250 billion. And if you trust the accountants, the net income is about $29 billion. You divide 250 by 29, you come up with a PE ratio of about 8, a little bit more than 8, maybe 8.5, 8.3, 8.4. That's pretty low, right? But if you correct the net income, remember the $29 billion in net income, you'd be adding about the same adjustment you did to the operating income. Your adjusted net income is going to jump to $43 billion. You divide $250 billion by $43 billion, you get a PE ratio of 6. Again, I'm not trying to tell you Facebook is cheap. I don't use PE ratios to pick stocks, but if you use PE ratios or EV to EBITDA multiples to find out what's cheap and what's expensive, and you're comparing Facebook to Coca-Cola or Navistar or a manufacturing company, you're comparing apples to oranges if you use accounting earnings. I think you need to clean up the earnings and then make your own judgment whether you'd buy Facebook at 6. Because from a valuation perspective, I'm not saying that the metaverse investments don't matter. They're cash outflows, obviously. But the value effect will depend on what you think the payoff will be from those investments. Right now, you know what I see? I see, at least in the market, investors basically saying nothing will come from this investment. Not even low cash flows. They're basically saying this is money down the drain. And it's a pretty cynical view of investing $10 billion in the most recent year, and at least according to plans, $100 billion over the next 10 years. But investors seem to believe that this is going to be wasted money. They don't trust Facebook on this. And you know who I blame? I blame the company. Because I've been looking over what the company has said about the metaverse, and I see almost no mention of a business model. What am I talking about? Hey, let's assume that we all buy Facebook virtual reality glasses. We put them on, we spend half our lives in the metaverse. Hey, for Facebook to make money, it's got to figure out a business model for the metaverse, right? Is it going to charge us a subscription for being in this virtual world? Maybe it's going to be transactions where you buy things, virtual things in the virtual world. Or maybe it's an extension of their advertising model. And Facebook has been remarkably remiss in filling in the details. In fact, that is going to be the topic for my next post, is they seem to have just lost the script. They've been actually very open about how much they plan to spend on the metaverse. In other words, they've given us all the bad news. But in a strange way, they don't want to fill in the rest of the details. They're being very opaque about what the upside here is. So take what you might out of the session, but what I would strongly recommend that you do is start treating expenses the way they should be. Start cleaning up for accountants. Not because you're a nitpicker, but because your investment judgments are being driven by these numbers. And you want to make sure, especially if you're comparing across companies or making assessments of value, that you're using numbers that reflect the true profitability, the true reinvestment, the true debt ratios or risk in a company. And right now, we're not getting that picture when we look at accounting statements. Thank you very much for listening.